Well, hello, Providence Financial friends and family. Anthony Sicaro here. Hope you're all doing great and happy New Year to you. I know it's February 20th, but I think this is my first video of the new year because I try not to put out things that you already know and try to only create a video when I think there's something useful that I can help you with. So that is the case here. So let me give you a quick heads up as to where this video is going, the reason I'm doing this video, so you can decide if you want to watch it or not. There is an announcement that I have to make. I'll start off with the announcement here very quickly, but then there's three things I want to talk about. I want to talk about number one, comparing the stock market to fixed income. That's something that a lot of you are doing. We've gotten a lot of questions about that. And you might be wondering, well, why did the market go up 24% in 2023 and your portfolios kind of stayed where they were? So we're going to address that. And that's where we're going to spend the most of our time. The second thing we're going to talk about is annuity upgrades. The third thing I want to do is I want to give you a quick update with regards to your income portfolio. So that's kind of tied with number one. So those are the three things that we're going to do. And let's knock off number two and three real quick, plus a quick announcement. So the announcement is this. I recently, within the last couple of months, signed a contract with KNX AM 1070. That's the biggest news station in California, one of the biggest news stations in the entire country. That covers all of Southern California for the most part. I know they get it up in Santa Barbara. I think they get it down in some parts of San Diego. So all of that. I was on KRLA, but now I'm on KNX 1070, much bigger. And we're on twice as long. Actually, if you look at it, we're on 4 times as long. I had a 30-minute show on KRLA that was run from 9:30 to 10 o'clock on Sundays. No, Saturdays. Sorry, but it was a half-hour weekend, whatever time it was. That tells you how much I remember that. So it was a half-hour a weekend with KRLA. That was the old show. We've canceled that contract, and with KNX, we are on for an hour at 6 o'clock Saturday mornings and at 7 o'clock Sunday morning. So we went from a half-hour a weekend to 2 hours a weekend. So something I just wanted to put out. So if you happen to listen to KNX, catch us at 6 o'clock in the morning on Saturdays or 7 o'clock in the morning on Sundays. And if you're not going to get up to listen to me at 6 or 7 o'clock in the morning, then don't forget about our podcast. Our podcast, those radio shows are aired on our podcast. The podcast is every Monday, and it's a replay of the radio show that just aired the previous weekend. And I think we have like 350 episodes on the podcast, something we've been doing for years. Everything you want to know about retirement. So don't hesitate to plug into the podcast. You can listen to that by going to providencefinancialpodcast.com, or you can search for the Providence Financial Retirement Show on your favorite podcast player. So that's how you're going to listen to the show if you don't want to wake up at 6 o'clock Saturday morning. So that's it. Just a quick announcement, but something we're excited about as well. So let's talk very quickly about the annuity upgrades. That's number two. When interest rates are high, it's extremely beneficial for annuity companies, for the financial industry as a whole. And so what we've been able to do for the last maybe 9 months or maybe a year now, because interest rates have gone up so much, is we've been able to upgrade many of your annuities. An upgrade means a couple of things. It means if you have an annuity designed to try to get you interest, right now we can get you more interest. If we have an annuity designed to get you income, you can get more income. And most of the times, especially for those of you that have income annuities where you have these lifetime income features on there, most of the times you can, by the time you're done, you can start off and have more money to begin with and more income down the road. And that's just because interest rates are so high. But it is a limited time opportunity only because the Federal Reserve is going to lower rates. And when they lower rates, rates are going to come back down. Income is going to come back down. It's not going to be as good. We have a window of opportunity that we don't know how long it's going to last. So far, it's been about 9 months or so. And I don't want you to miss out. Now, Tuan Lam, who is our client service advisor, has reached out to many of you, and you've already spoken with him. And if that's the case, if you've already spoken with Tuan and you've already upgraded your annuity, you don't need to call us back. Tuan's been on it, and you've already done what you need to do. But if this is the first time you're hearing about it, or if you haven't heard from Tuan, there's a lot of reasons why that could be. It could be that maybe it's not something you qualify for, or it could just be something that maybe it's an annuity that we didn't set up for you. So it doesn't have to be annuities that we set up. If you have any annuity at all set up by anybody, you want to find out whether you can upgrade it. And I can't promise you whether you can or not, but you want to find out. The primary criteria, what we have found, is that it has to be older than 3 years. If it's less than 3 years old, it's probably not going to work. So if your annuity is older than 3 years, even if there are still penalties on it, as there are likely to be if you have only a 3-year annuity, you still want to consider upgrading it. Because even with the penalties, you'll still come out with more than, a lot of times, you'll still come out with more than your current balance is right now. So if you're just not sure, contact Twan at my office, 818-887-6443. Just ask Twan. He'll look into it and let you know whether it's something you want to do or need to do. So that's quick announcement regarding annuities. The next topic, very quickly, ties into the first topic. So we're going to talk about income portfolios just ever so briefly. I don't want to repeat what you already know. But then we're going to talk about the stock market as well, too. So with regards to income portfolios, you know that's what we focus on, right? Income investing. Well, in 2022, your portfolios, the income portfolios, dropped by about 13%. And that was the 2022 value. And for people that we were talking to in 2022, what I was telling you is that, wait, when the Federal Reserve starts to lower interest rates again, you're going to see it bounce back. Well, the Federal Reserve in 2023 didn't lower interest rates, but what they did is they stopped the rate at which they were raising interest rates, and that was enough to cause the portfolios to bounce back. So in 2022, they were down by 13%. In 2023, the fixed income portfolios across the board were up by about 15%. So now you might say, okay, well then I'm up 2%. Not really, because when you do the math, if you're down 13% and you come back 15%, well 15% on 87% of the money is still going to be about 100%. So just about break even over 2 years. And it certainly is going to depend on how you're invested. You're all invested a little bit differently. You're all focused on income, but how you're invested for income is going to be different for each of you. So your fluctuations may be out of those numbers, but as a whole, that's what happened. 2022 down 13%, 2023 up 15%, so flat. Now, that's on a total return basis. And how much do I care about total return? You know that answer. I don't care at all about total return. But some of you have asked, and I did want to bring that up because the whole time that you've been watching your balance fluctuate, you've been getting your income. And if you've been spending your income, then you know it doesn't matter the fluctuation. It's just noise because your income stays the same. If you've been reinvesting your income, then you actually want the portfolio to go down a little bit because that means when we reinvest the income, you get a discount. So the fact is in 2022, when the portfolio came down by 13%, if you're reinvesting your interest and dividends, you actually get a 13% discount. So now when they come back, you actually come out smelling like a rose. So whether you are reinvesting your income or living your income, living off of your income, the fluctuation doesn't matter. It's just noise. And that's the nice thing about being invested for income. It's what I often refer to as winning no matter what. I talked about this at our client appreciation event that we did, I think, last November. Winning no matter what. And when you're living off your income or you're reinvesting your income, then it doesn't matter what happens. It doesn't matter what the market does. It doesn't matter who the president is. It doesn't matter what wars are going on because you're living off your interest and dividends. You're leaving the chickens alone. You're living off of the eggs. So I wanted to just remind you of that and let you know that, 2022 down, 2023, everything came back. But one question that we've been getting just over the last, really, since the beginning of the year, we've started to get this question a lot. And then I know when we get a question once or we start to get it a lot, then, a lot of you are probably wondering the same thing, even though maybe you haven't called us to ask. And the question is this, the market was up 24% in 2023. And my portfolio was flat. Why? And so I want to address that. And so first of all, let me say a couple of basic things I think right out of the gate. Number one, you're not invested in the market. Your fixed income portfolios are not invested in the market. So you can't compare it to the market. That's like having a basket of apples and asking, the price of oranges went up, and how come asking why the price of apples didn't go up? Because they're not oranges. They're two different things. So you don't want to compare apples and oranges. I guess that's a good way of saying it, but that's very true. And you're comparing apples and oranges. If you're going to be in the market You must be able to sustain a 50% loss. It doesn't mean we're going to have a 50% loss, but we've had two 50% losses in the last 24 years. Well, the market's gone down 50% or more in the last 24 years. We know it could happen again. It's happened many times. And so whether it actually happens or not is irrelevant. You have to be able to take the risk of a 50% loss in your portfolio in order to be invested in the market. And a lot of you, if you put a chunk of money in the market and you lost 50% of your portfolio, it would wreck your retirement. You wouldn't be able to do the fun things you want. You wouldn't be able to get your income anymore. You wouldn't be able to sustain and your retirement, your lifestyle. It would wreck. It would devastate your retirement if you took that kind of loss. And I don't think any of you have ever told me that you're willing to take a 50% loss in your portfolio at this stage. Now, does that mean that you don't want anything in the stock market? Well, when we focus on stocks, right, we're talking about dividend stock and stock that's still going to give you income. When we put together a dividend stock portfolio for our clients, you're still going to get somewhere between 3 and 4% of dividends, depending on the final portfolio. So you're still getting income you can live off of, and you still have potential for growth. And do I think it's a good idea to have some in that? Well, in stocks that pay dividends? I think the answer is yes, but it also depends on your situation. Some of you can afford to take 20 or 30 or 40% of your money and put it into dividend stock and let it ride and maybe live off the dividends and get some growth, and your stomach allows you to fluctuate the ups and downs and the volatility that you're going to have with that. Some of you can afford to do that. Others of you cannot. So it just depends on your situation. But I don't want you to be invested in such a way to where you can only win and you can only do the things you want in retirement and you can only take the trips and you can only give to the grandkids or charities. I don't want you to only be able to do that if the market continues to do well. I want you to be able to do that no matter what. And that's what income allows you to do. So if you want to take a little bit of risk, and you can take 20 or 30%, a lot of you already have 20 or 30 or maybe 40% of your money in the market. If you want to do that, feel free to let us know. Call us, call me, call Twan, let us know. And I'm more than happy to talk about reallocating some of your portfolio. So first of all, though, you have to be willing to take a 50% loss. And it then doesn't mean it's all or nothing. We don't have to put all your money in the market. We could just put a sliver of your money in the market, again, 20, 30%, and get the income off of that and get a little growth that way. So that's the one thing. You have to be willing to take the risk. And a lot of you are not. I know that. And I don't want you to be in a position, and I don't want to be in a position to be talking to you in a year or two about why we put money in the portfolio. And now your portfolio's got slashed and you can't do the things you want. That never happens with income. When you're living off your income, we will never have to have that conversation. So that's the first thing that I kind of wanted to address. The second thing I wanted to address is the fact that we as investors tend to have short memories. A lot of you have called and said, market went up 24% last year and my portfolio just kind of stayed flat. And then you've been listening to the media and this is what's happened and you want to know why. But I need to take you back a couple of years. Because if what you have to remember is that the market came up 24% last year, but it went down 20% in 2022. Here are the numbers. The market went down exactly 20% in 2022 from December 31st of 21 to December 31st of 2022, 1 year. The S&P 500, sorry, I don't like reading glasses, but I actually like reading. So the S&P 500 from December 31st, 21 was 4,766. And if you look at December 31st, 2022, it was down 20%. I don't have that number. But then by December 31st of 2023, the S&P 500 was at 4,769. 2 years, December 31st, 2021, it was at 47.66. December 31st, 2023, it was at 47.69. Dead flat. 2 years, dead flat. Zero growth for 2022 and 2023. Zero growth. The market is now up I did the numbers, like 4.7%, but that is this year. That is only in 2023. So we can say for the last 2 years that the market's up 4.7%. What is that? Divided by year. 4.7 divided by 2 is what? 3.3 or something like that, right? No, sorry. Apparently I can't do math. 4.7 divided by 2 is 2.5. 2.35, somewhere in that range is what it would be. It's 4.7. So 2.35% a year. That's what the market has done over the last 2 years. But the media gets us focused on the fact that 2022 was a good year. Yeah, it was a good year because it just made up for the bad year that 2022 had. You don't want to remember that. You don't want to forget that. Meanwhile, I think a lot of you have forgotten that. And meanwhile, with income portfolios, you've been getting, depending on how you're invested, 5 or 6% a year, right? Maybe 4 if you're a little more conservative. So somewhere between 4 and 6% a year. So that means that over the last 2 years, you've gotten between 8 and 10% of income that you've either spent or you've reinvested. So you tell me, what's been better over the last 2 years, stock market or income? I will argue that income's been better. But a lot of you have called us and said, hey, market's done, 24% last year. My portfolio's kind of been flat. Yeah, we're just looking too short term. So that's it. So I did want to bring that to your attention. And again, I also want to bring it to your attention that if you are feeling lucky, if you do feel like things are going well, if you do want to add some to the market, I wouldn't discourage that. I think having something in the market, again, no more than maybe 20, 30%, especially with dividend stocks, I think that's prudent. And some of you can afford to do that. Some of you we've already done that for. And if we've already done that for you, you probably don't need to call us again unless you think you want to add more to the market. And some of you have maybe been a little shy away. Maybe you're wondering whether you should do that. And if that's the case, if you're wondering, email me back, email Twan. Get in touch with us. Let us know. We'll put you on top of the list and we'll look and see if maybe you should be adding something to, some stocks or some equities to your portfolio. But that's going to be kind of a one-on-one, conversation. Now, last thing I want to say is we're not out of the woods yet. I've said this on multiple media interviews that I've done over the last couple of months because I kind of feel like a lot of people are thinking we're out of the woods. We're not. We're not out of the woods yet. The fact is that there's still an inverted yield curve. And there's still potential for recession around the corner. Stock market's doing really well. The economy is doing really well. Labor market's strong. Inflation is down, but it's rising again. That's a big deal, actually. So we got to pay attention to that. And we're not out of the woods. There still could be a recession. The stock market was pricing in the fact that just a couple months ago that there would be 6 rate cuts this year. Right now, it's less than 4 rate cuts, and I would argue that it's possible that we don't have any rate cuts this year. But if we have a recession, that's going to cause some rate cuts. And guess what? If we have a recession, then in fact, it's not going to be good for the stock market, right? And that means that if you put money in the stock market today, it could still fluctuate down. So we're not out of the woods yet. Bottom line is this. Your income portfolios have done better than the stock market over the last 2 years, so you don't want to compare it to the last year. If you want to add some money to stocks, call us. I think that'd be a good idea to do. And certainly we can talk one-on-one about shifting maybe 20 or 30% or whatever is right for you into the stock market, still focusing on income. And then your income portfolios have bounced back like we talked about as well. And don't forget about the annuity upgrades. If you have an annuity of any sort and you haven't talked to Twan and it's more than 3 years old, call Twan, let him do an analysis, see if upgrading makes sense. And plug into my podcast, my radio show, 6 o'clock Saturday morning, 7 o'clock Sunday mornings, or the podcast at providencefinancialpodcast.com, or search for the Providence Financial Retirement Show on your favorite podcast player. Thank you for your loyalty. Thank you for being clients. I don't take it lightly, and I appreciate you putting your trust in us. If you want to have a conversation, please reach out. God bless.